Sherman Waters. I think that's the first time the financial services ever invaded the FDIC and giving, was those subpoenas or just invitations?
Well, first of all, we haven't invaded anything.
I know, I'm just...
We have a visit, and this is important sometimes for members to get up, particularly when you have not had a confirmation of a visit from Mr. Otting and the OCC to come and see how it all works. And we're particularly concerned because we wanted FDIC to take another look before they sign on to this proposal. And so we have learned today, based on the excellent testimony from Mr. Gruenberg, that there are a lot of problems with this proposal, and we have to deal with that.
Thank you, Chairman.
Thank you.
So,
Thank you,
so if we can
Mr.
just
All right. Staff, any other questions or comments? Thank you. And again, thank you for helping us move the framework forward. May I have a motion with respect to the notice of proposed rulemaking?
I so move.
Thank you. And a second?
Second.
Thank you. All in favor say aye.
Aye.
Any opposition? The next item is a memorandum. Actually, I would like to recognize that we have a congressional delegation here with us, led by Chairwoman Maxine Waters. We just saw you last week. I'm glad we get to see you again. I'm sure you came for Joseph.
This is great.
And where I come from, where I was born, there is a saying that goes something along these lines: if you can't come to the hill will come to you. And in this case, I think the hill literally came to us for you. So welcome. Thank you for
I like
being
these
here.
field trips. I'd like to invite you to the OCC someday.
We would like to invite you to a hearing. All right, the next item is a memorandum and resolution regarding the proposed 2020 FDIC operating budget. Brett Edwards and Tom Pettifor will present the case, please.
Well, I'm going to give you another invitation. Will you come over here, staff, and what's
I confirm that I can make the 28th.
No, they tell me you have
This is great.
confirmation, and you actually just 60 more days. Why not get your information?
We're open having people come in and do this.
60 more days for comments.
How do you know you need it?
Well, you know we need it because we've been getting people who are concerned.
We're going to have them come over to the OCC and sit down.
Well, why don't we make it official?
To come over and stuff.
Formal and official, and you just agree to 60 more days.
I think we can walk people through the proposal in 60 days
Well,
and give them
I
time.
want to tell you something, what you're concerned about it, and you mentioned that the Treasury supports your proposal, and this is something that they
No,
propose.
Treasury did an independent analysis.
Well, I want to tell you, you know, you and Treasury, that you and Mr. Newton, you have made this decision.
We're happy to come over and spend time, as I have in the past,
Well,
as I've talked to you on the phone.
continue to invite you to the conference, and we're happy to continue to ask you to extend for 60 more days. We're happy to do that.
And I just invited your staff to come in January so we can walk through the logistics and explain the numbers.
Not just coming on and talking on it.
It won't start. The comment period probably won't start for another 2
Excuse
weeks.
me, where's Chris? Because I want to make sure we get the right invitation. Please don't leave. We're starting. I have an extended invitation for you.
This is great.
That's what we like.
Okay, all right.
Are those subpoenas?
Oh, we have a whole premise. Yeah, no, we have. That's no. We can send you the budget. The four that had failed. This will publish. It's only in our report. We'll send you. This was a brief version of just the budget from the financial perspective.
As your budget decreases, it does not talk about the responsibilities that are there. And what you're
Oh,
going to
absolutely.
do to support.
No, it's all in our budget.
Development institutions.
We have
Give us 6 minutes.
Oh,
often complex and nuanced, and at times somewhat removed from an ordinary person. CRA is not one of those statutes. In fact, CRA, unlike so many other statutes we deal with, touches the lives of ordinary Americans in a direct way that is somewhat unique in our bank regulatory framework. When a law or regulation becomes out of sync with the technological and business changes, the beneficial impact of such law regulation can diminish. The impact of CRA regulations becoming out of sync with technology banks utilize to offer banking services is all the more compounded and pronounced for the communities the law intended to serve. Last night, we had an opportunity to screen a documentary featuring Ambassador Andrew Young, The Color of Money, and I especially appreciated the discussion we engaged in afterwards, where Ambassador Young told us about the benefits of CRA to the communities he is trying to help. At its core, the CRA encourages banks to help meet the credit needs of the communities in which they are chartered, including low and moderate income communities. This statutory objective remains as critical today, perhaps even more so, as it was over 40 years ago. However, in light of the transformative changes in the banking industry during this period, including the advent of digital banking, it is clear that the regulations implementing the law must be updated if they are to fulfill this objective and their congressional intent. Today, the board considers a notice of proposed rulemaking that would modernize the regulations implementing the CRA, the last major revisions of which were made in 1995. The proposal will preserve the aspect of the regulations that are working well, while updating outdated components and providing much-needed clarity to financial institutions, resulting in an improved framework that will benefit LMI communities across the nation in a way that CRA currently cannot. The principal goal in undertaking these reforms is to increase LMI lending. Our proposal seeks to achieve the goal in several ways, including by encouraging banks to make long-term commitments in LMI communities by providing greater credit for retail loans retained on balance sheet, increasing to $2 million the size of qualifying loans to small businesses and small farms to encourage economic development and job creation and to help family farms, providing CRA credit for retail and community development activities in Indian country, and expanding the activities that qualify for CRA credit to include capital investments and loan participations undertaken by a bank in cooperation with community development financial institutions, or CDFIs, regardless of where the CDFI is located. In addition, the proposal would clarify the activities that qualify for CRA credit in 2 key ways. First, it would require the FDIC and OCC to publish periodically a list of illustrative examples of qualifying activities and establish a process for stakeholders to seek agency determination of a qualifying activity. Second, it would establish new performance standards to assess the distribution of qualifying retail loans originations to LMI individuals and to small farms and small businesses in an assessment area, and the quantified value of the bank's qualifying activities relative to its assessment area and bank level retail deposits. Both components would be compared to specific benchmarks and thresholds that would be established prior to the beginning of a bank's evaluation period. We believe these steps will incentivize great CRA activity by enabling banks to plan activities without the risk of such activities not qualifying for CRA credit, while ensuring that they do serve the communities they're supposed to serve. The proposal would also recognize the evolution of the banking system, including the emergence of digital banks, by requiring banks to add assessment areas where they have significant concentrations of retail domestic deposits. This proposal, which recognizes that banks may now receive large portions of their deposits from outside their traditional assessment areas under the current CRA framework, conforms with the CRA's congressional intent to ensure that banks help meet credit needs where they collect deposits. The proposal would leave intact existing provisions for banks to delineate assessment areas where they have their main office, branches, and deposit-taking facilities, and to include in those areas the surrounding geographies where banks originate or purchase a substantial portion of their loans. Finally, the proposal would ensure that small banks are not overly burdened by the need to overhaul their existing systems or collect and report extensive data to comply with the new framework. Accordingly, the proposal would allow small banks, those with 500 million or less in total assets, to select to be evaluated under the current rules or to opt in to the new performance standards. I would like to close by emphasizing the need for robust public comment on this proposal. As with any comprehensive set of reforms, we rely on stakeholder feedback to help us make further improvements. We will continue to engage with banks, community groups, congressional leadership, and other stakeholders as we work to improve the proposal and finalize these changes. The proposal reflects hard work, collaboration, and coordination among the FDIC, OCC, and Federal Reserve Board, including many recommendations from staff at all three agencies. Although the Federal Reserve Board has not joined the proposal at this time, I appreciate their engagement and recommendations for improvement, many of which are reflected in this proposal, and I look forward to continuing to work with them as the proposal moves forward. I would be remiss if I didn't thank each and every one of you. It took months of negotiations even before I joined the FDIC to get to the place where we can actually have a proposal on the table. And I know that all of you did so with the best interest of the public we're trying to serve in your heart and your minds. Thank you for that. I support this proposal, and I hope that the board will as well. Thank you. Do we have any other statements? Marty? Go ahead.
Thank you. The notice of proposed rulemaking before the FDIC board today is a deeply misconceived proposal that would fundamentally undermine and weaken the Community Reinvestment Act. And for that reason, I will vote against this NPR. The Community Reinvestment Act was signed into law over 40 years ago. Over the course of its history, it has become the foundation of finance for low and moderate income communities in the United States. As the preamble to this NPR states, and I quote, "Since becoming law in 1977, the Community Reinvestment Act has encouraged insured depository institutions to invest trillions of dollars into the communities they serve, including low and moderate income neighborhoods," close quote. The regulation implementing CRA has not been significantly revised since 1995. Given the evolution of the banking industry over that period, there is certainly reason to consider revisions to the CRA regulation to enhance and strengthen its effectiveness. For example, there's general agreement that as technology has expanded opportunities for access to financial services, consideration should be given to how CRA could be adapted to include communities in which banks do substantial business but do not fall within existing branch-based assessment areas. In addition, under the current CRA regulation, community development is considered in the lending services and investment tests. It may make sense to create a single community development test that would include lending services and investment, complemented by a retail test which would include lending and services. Further, finding ways to ensure greater consistency and predictability in CRA evaluations would also have value, providing greater certainty to bankers and community organizations as to whether proposed investments or loans would receive CRA credit is a commonly shared goal, although it poses challenges in practice. The NPR before the FDIC board today would seek to address these issues. However, it would do so in a misconceived, unworkable, and damaging way to CRA. At the core of this proposal is the establishment of a single metric CRA ratio, or a CRA evaluation measure, as the proposed rule labels it, at the bank and assessment area level that would be the ultimate determinant of CRA performance. Under the proposal, it would be a bank-level CRA evaluation measure and an assessment area CRA evaluation measure. The bank level and assessment area measures would be the sum of the value of all the CRA qualifying activities divided by the value of retail domestic deposits at the bank and assessment area levels respectively. The proposed rule prescribes presumptive measures to determine a bank's CRA rating. For example, at the bank and assessment area level, the CRA evaluation measure of 11% would be required for an outstanding rating, 6% for a satisfactory rating, 3% for a needs to improve, and less than 3% for a substantial noncompliance. In addition, the bank would need to achieve a rating of outstanding or satisfactory in a, quote, significant portion of its assessment areas in order to receive an overall outstanding or satisfactory rating. The proposed regulation does not define the term significant portion, but the preamble suggests, and I quote, such as more than 50%. The proposal provides for pass-fail retail lending and community development tests, but these really are supplements to the CRA evaluation measure. It is the presumptive CRA evaluation measure, or single metric, that's the dominant determinant of the CRA rating. Now, as the preamble to the proposed rule points out, in regard to the commenters on the advance notice of proposed rulemaking on CRA that the OCC issued, and I quote, the majority of commenters support objective measurement of CRA performance, although they oppose a single metric, close quote. Yet a single metric at the bank and assessment area level is the foundation of the evaluation framework of this proposed rule. It is problematic in several ways. First, under this single metric approach, a bank must calculate the value of its CRA qualifying activities at the bank and assessment area level based on the dollar value of qualifying activities originated, made, and purchased by the bank. The problem with this approach is that adding up the dollar value of qualifying activities, lending, community development investments, and community development services into a single metric undermines the evaluation of the bank's performance in each of these areas. It's a count the widgets approach that does not take into account the quality and character of the bank's activities and its responsiveness to local needs. Second, taking this dollar
Good afternoon, Chairman McWilliams and members of the board.
and dividing it by the value of the bank's retail domestic deposits, whether at the bank or assessment area level, is also problematic. As the preamble to the NPR points out, and I quote, deposit data have limitations because the current reporting framework records deposits by attributing them to a branch location rather than the account holder's address, and uses a different definition of deposits than the proposed rule. The proposed rule would remedy these deficiencies by leveraging data that are readily available but not currently reported in an integrated and accessible manner. Over time, the data collection, record keeping, and reporting requirements in this proposal would remedy the current limitations. While the assumption that the data may improve in the future is not an appropriate basis for proposing changes to the CRA regulations now, based on currently available data that is known to have deficiencies. Third, the presumptive numerical standards for the CRA evaluation measure are not adequately supported in the proposal. As the preamble to the NPR states, although these data sources have some limitations, by using all the sources together and making a limited number of assumptions, the agencies were able to estimate what each bank's average CRA evaluation measure would have been from 2011 to 2018 under the framework and the proposal for all banks that filed a call report. The preamble then goes on to state, Based on the agency's review of these factors thus far, the agencies believe that the average CRA evaluation measure benchmarks associated with each rating category should be set at between 10 and 15% for outstanding, 5 and 10% for satisfactory, 2 and 5% for needs to improve. The proposal was set 11% as the initial benchmark for outstanding, 6% as the initial benchmark for satisfactory, and 3% as the initial benchmark for needs to improve. An average CRA evaluation measure of less than 3% would be associated with the substantial noncompliance category, close quote. No explanation is given as to how these specific benchmarks were determined, and none of the analysis referenced is provided. They appear to be arbitrary, yet they are the basis for establishing new presumptive standards for CRA performance. These presumptive standards undermine one of the most important benefits of CRA, the incentive for banks to develop partnerships with local community organizations and other stakeholders to address community needs, because the banks can satisfy their CRA obligations by simply hitting the metric. Further, the single dollar value-based metrics favor large, easy-to-accomplish investments and loans over more complex and innovative activities that may take longer to develop but have a higher impact on the community. Finally, this proposal would allow a bank to achieve a less than satisfactory rating in nearly half of its assessment areas and still receive a satisfactory or even outstanding rating. Banks would have the flexibility to focus their stronger community reinvestment qualifying efforts on as few as half of their assessment areas while minimizing their efforts elsewhere. The challenges presented by this single metric CRA evaluation framework are compounded by other aspects of this proposal, and I will highlight 3. First, the NPR expands eligible and qualifying CRA activities to include some of what banks already do in the ordinary course of business, thereby diluting the effectiveness of CRA. For example, community development activities, loans, investments, and services would no longer have to have a primary purpose of community development targeted on low and moderate income individuals in areas, small business or small farms, or underserved or distressed rural areas. This broadening of what counts in the proposal comes at the cost of CRA's historic focus on serving low and moderate income communities and individuals while giving the appearance of expanding the overall level of CRA activity. A second issue is how the proposal would address assessment areas. Under the proposal, a bank that receives 50% or more of its domestic deposits from outside its current branch-based assessment areas would be required to delineate deposit-based assessment areas where it receives 5% or more of its total retail deposits. However, as previously noted, the deposit data needed to implement this are deficient. We don't know how many or where these deposit-based assessment areas might be or how they would benefit low and moderate income communities. It is not clear that communities that are so-called credit deserts would necessarily benefit from the 5% threshold. In fact, the effect of this proposal may be to add assessment areas in places that are already CRA hotspots such as New York City or Silicon Valley. Finally, the NPR would virtually eliminate the retail services test, retaining minimal recognition for branches in low and moderate income areas. There would be no consideration of a bank's efforts to provide affordable products and services intended to expand access to the banking system the low and moderate income individuals who are currently unbanked. This would undermine the FDIC's long-term effort to address this issue. Low-cost transaction and savings accounts, which the FDIC has helped to promote, will no longer be considered for CRA credit simply because these accounts cannot be quantified under the single metric system that would be set up under the NPR. In conclusion, this is a deeply misconceived proposal. It would establish a CRA evaluation framework relying on a single metric approach that would allow a bank to concentrate its CRA activity in as little as 50% of its assessment areas, disinvest in the other 50%, and still receive a satisfactory or even outstanding CRA rating. The metric itself would establish presumptive percentage standards for CRA ratings for which no basis is given. The metric, as well as new CRA assessment areas, is reliant on retail domestic deposits for which reliable data is deficient. The proposal would expand current CRA eligible activities and thereby reduce the focus on low and moderate income individuals and communities. It would virtually eliminate the retail services test that currently encourages low-cost bank accounts to expand access to the banking system to those who are currently unbanked. Finally, the proposal undermines what has been a core strength of CRA for 40 years. The encouragement of bank engagement and dialogue with stakeholders and local communities to understand and better serve historically underserved areas. Taken together, this proposal would fundamentally undermine and weaken the Community Reinvestment Act, and for that reason, I will vote against this notice of proposed rule.
Joseph?
Yeah, thank you. Thank you, Madam Chairman, and thank you for your leadership throughout the development of this joint proposal and the many other rule writing efforts that we've accomplished this year. This morning, I approved the notice of proposed rulemaking to strengthen and modernize CRA regulations on behalf of the Office of the Comptroller and the Controller, and we'll vote to approve this proposal here today. Since 1977, the Community Reinvestment Act has steered trillions of dollars into neighborhoods across our country, helping to reinvigorate those communities by meeting the credit needs and investing in vital community development projects. Today's joint proposal will help ensure CRA remains an effective and relevant tool to encourage more lending, more investment, and more services in communities where banks serve low to moderate income neighborhoods, small business, minority deposit institutions, Indian country, and family farms for generations to come. Today's proposal reflects the efforts of dozens of dedicated staff at the OCC, the FDIC, and the Federal Reserve, as well as thousands of stakeholders who have advocated for improvements in the current framework since it was last updated in 1995. I can't tell you the work that I appreciate, the weekly meetings that we did at the staff level and the principals level. It was, I think, a great learning experience for all of us. I'd like to personally thank you for your efforts and that you worked so hard to produce the NPR. And while this work began more than 18 months ago, it has roots that are much older. The proposal is consistent with the feedback that the federal banking agencies began gathering in 2010 in hearings across the country, as well as the 3-year review of laws and regulations that was published in March of 2017 in a joint report to Congress. Marty, I know you were part of that process as well, so thank you very much for that. The proposed rule is also consistent with recommendations published by the Treasury Department in April of 2018 and feedback published by the Federal Reserve in June of this year. Perhaps more importantly, the proposed rule is informed feedback OCC staff and I heard from thousands during outreach and bus tours conducted over the last year, and by 1,500 comment letters that stakeholders submitted in response to the advance notice of proposed rulemaking that was published in August of last year. 94% of the ANPR comments indicate that the current process lacks objectivity, transparency, and fairness. 98% said that it was applied inconsistently and 88% said it was hard to understand. The preponderance of the feedback from every source points to 4 basic improvements that this proposal would make. First, the proposed rule would clarify what counts for CRA by articulating clear standards and requiring agencies to publish a list of qualifying activities. I think we're all amazed, since this rule was published in 1977 and modified in 1995, there's never been a list for community groups, nonprofits, civil rights organizations, and banks to be able to collate around actually what does qualify for CRA. We'll fix that. We can eliminate the guesswork by community members and what counts for banks. Second, the proposal preserves assessment areas in the local markets around branches and would require banks that draw a large portion of their deposits outside of their facility-based assessment areas to designate additional assessment areas wherever they have significant concentrations of deposits. And as internet banks have come on the scene, significant amounts of institutions may be domiciled in one geographic area, but they're gathering deposits from others. This proposal will have the expectations that they'll serve those additional communities. Third, the proposal would evaluate CRA performance more objectively by assessing what portion of a bank's retail lending is targeted to LMI individuals in areas, as well as measuring the impact of that activity by comparing the value of a bank's CRA qualifying activities with its deposit in each assessment area and at the overall bank. And this is more than a one single metric that you heard Marty mention. At each of the assessment area, we would look at the actual units, and we'd compare the bank's activity in the actual units, and then we'd compare the market and the units that were done in LMI, and then we would also compare the dollars, and then we would compare at the top of the bank. So effectively, there are 3 key measurements that would be using in the proposal. And so I think the fourth is the proposal would improve the transparency and timeliness of reporting. Better reporting will allow stakeholders to gauge banks' performance throughout the evaluation cycle and should help speed up regulatory decision making. As most of us know, after the 3-year examination period, it can take on these large sophisticated banks 1 to 2 years to actually get the final report completed. The proposal would generate many benefits for the communities that banks serve, the advocates who support those communities, and the banks we regulate. Above all, I believe these changes will encourage banks to lend, invest more in the communities that need it most. The proposal would refocus qualifying retail activities on LMI individuals in areas. We've closed a significant amount of the loopholes where the focus could be not on LMI areas. It would also provide more incentive for banks to lend and invest in urban and rural underserved areas, generate more support to small businesses and small farms, and provide credit for lending and investment in Indian country and distressed areas. While today's proposal is an important step, it is not the final step. Stakeholders now have the opportunity to help us improve this proposal through their thoughtful comments. And Marty, I very much welcome you, providing us comments on the proposal so we can integrate those. And I encourage stakeholders everywhere to read the proposal and take advantage of this opportunity to provide the thoughts so that a final rule modernizing CR regulations can be even stronger. Thank you very much, Chairman.
Thank you, Chairman. The proposal in front of us today obviously provides comprehensive amendments to the regulations implementing CRA in an effort to improve the current CRA regulatory framework. As all of you noted, this is really the compilation of 10 years of conversation, a lot of research, a lot of staff effort, a lot of input from the communities that would be affected and from the financial institutions that carry out the important goals that Congress set in CRA. And certainly, again, financial institutions play a huge role in the communities that they serve, investing in those communities, and required by law, which is really what we're trying to do here in terms of encourage and incentivize that investment, modernize the framework so that we are achieving that important congressional intent. I'm not going to belabor the points that all of you have raised here. I think it is important to note that we do have a lot of work by 3 agencies, certainly by the principals in those agencies, to try to improve this. There are a lot of pieces of this proposal that have consensus around them. And I think there is an opportunity here, again, with it being a proposed rule, for stakeholders to come back and for us to truly understand and ensure that we are meeting the intent of the law and putting forward something that's going to modernize CRA so that financial institutions are meeting the needs of communities that they serve, particularly low and moderate income communities. So I thank you for all of the efforts on this proposal and very much look forward to the comments through the process.
Okay, thank you. I do have a question for staff. Maybe one of you can just highlight for us exactly when the banks take deposits that are digital deposits. How do they account for those deposits under the current framework?
So currently when banks take deposits, they will assign them to some branch. So if I have 2 branches in different areas, but I receive deposits way outside those branches, let's say outside the state, they by definition have to assign those deposits to a particular branch and all. What the proposal would do is, and they have the address of the depositors, that is, they know of course where the depositor resides. But what the proposal would do is basically take the information that the banks have and look to see whether the bank should create new assessment areas. The CRA was founded on the notion that banks that take money from communities have an obligation to invest in those communities. This proposed definition of a new assessment area would simply take that principle and apply it to the contemporary banking system.
And under the current regime, can they apply the deposits in the example of the 2 branches you gave arbitrarily? One branch or branch 1 or branch 2, or is there any kind of a rule how they apply it?
No, there's no rule now. They can do it. It's in their discretion how they would apply it.
Okay, all right, thank you.
Most banks have what they call geocoding, so you'll have a branch location, but you can geocode to where the actual physical location is. It's frequently used by banks where you're looking at, do I open up a new branch and where the customers are at the existing branch? You can scatter plant that, so it'll be easy for the banks to be able to have that.
That's under the proposal, but not under the
No, I'm
current.
saying what banks actually do in practice.
Yeah, okay. All right, and Joseph, I would be remiss if I didn't thank you for, this process started well before I joined the FDIC, Marty. I know you were involved in that, and I know you've been involved in this area since 1977, so I would love to get your feedback if we can improve the proposal, or we can maybe gain your support along the way. Thank you, Kathy, for your comments as well, and thank you, staff, again, on all the work you have done. I look forward to see how this develops. May I have a motion with respect to the notice of proposed rulemaking, please?
So moved.
Thank you, and a second? Second. Thank you. All in favor, say aye. Aye. Any opposition?
No.
Thank you. Thank you all very much. We will now move in immediately into closed session of the board meeting.
Excuse me. Oh, that's great. Sorry.
It's good to see you.
Wish I'd.
period for comments on the rule, and that we need to understand this proposal better. We're concerned about a single metric, because even though Mr. Otting describes that they do the evaluation in 3 areas, it's not reflected in a single metric. I am absolutely concerned about 50% of the assessment areas not in compliance and still the bank getting a satisfactory rating. I am concerned that in the final analysis, this proposal does nothing to absolutely actualize the intent of CRA to service, the low-income communities, minority communities, and I'm worried about the part of the proposal that says now they give consideration to deposits that are coming from outside of the state even, I suppose, so that they can give assistance to where those deposits are coming from. So there are a lot of problems, I think, with this proposal. And we have tried to work out a time for Mr. Otting to come over to and testify, and he's been absolutely too busy, so we thought we'd come to see him. And so we have given him another invitation, and we want the comment period to be extended for 60 days so that the kind of input that is needed to bear on this proposal can be done. We have people who are calling us who have learned about single metric and some of these other things. They're very concerned about it. We need more time for comment on the rule. And I'd like you to also know that, the other members who are here today are very concerned about that. Mr. Sherman, Mr. Foster, and we had some who had to leave early, but please share your comments with them.
The proponents of the rule talk about how CRA has not been revised since the 1990s. If we're able to wait 2 decades, we can wait another 60 days.
That's right.
And make sure we get it right, because we may not be doing it again for another couple decades. Let's get it right. And getting it right starts with some respect for the Financial Services Committee that includes coming to testify. It is extraordinary and entirely delightful for us to come here, but I'm sure it would be equally delightful for Mr. Otting to come to the Financial Services Committee.
Foster. Yeah, my concerns in large part are technological. You know, what does it mean if you're banking by cell phone to reinvest in a community where your bank may be, you know, thousands of miles away? And we have to look holistically at what reinvestment means. Because if an investment that's made inside a gated community is entirely different than one that's across the street outside of a gated community. And so that there are real opportunities here with a rule that takes advantage of all of the modern power of data analysis to really do what we're trying to optimize for here. And if I could, you know, step back from all of the metrics that are being talked about and say, what are we trying to accomplish? What I'm trying to accomplish is making it likely that someone from a very different socioeconomic group is likely to meet face to face with someone else, you know, at the store, at the place they live, at the communities they live, because that is the way we get social progress in our country, by not allowing areas to become banking wastelands and others to flourish.
So we thank you very much. We are serious about our oversight responsibility. And we're not going to sit there and not take whatever time is needed to make sure that we weigh in on a proposal that has already been agreed on, I suppose, by Mr. Mnuchin and Mr. Otting. We're not going to do that. Thank you very much.
Madam Chair, the list of activities has now broadened to Native American areas and other things as well. Is that something that you're happy with in this proposal? And is there anything in this that you were
want the
open
CRA
to?
to operate in the way that it was intended to operate. It is intended to operate, and certainly that is to serve low-income areas, to serve the unbanked, et cetera, et cetera. And of course, we support that aspect of doing that. But there's so many other things that are not good with this proposal that we have to weigh in on that also.
Should the Federal Reserve take the lead on this? They have pretty good standards. The Federal
One
Reserve
question
Bank.
per outlet. You've already asked your question, sir. Politico, Bloomberg, American Bank.
Your thoughts on the Federal Reserve's absence?
Yeah.
I beg your pardon?
Yeah.
What do you think of the Federal Reserve's
The
absence?
Federal Reserve have not weighed in to support this proposal, and that's what their absence means in my estimation.
Do you feel like that your input was taken into account at all in the development of this
No,
proposal?
I don't think that Mr. Otting has been willing to have anybody else involved in the proposal. He thinks that he has the authority to do this without having to interact with us, and no matter what he thinks, we think we have a responsibility to make sure that CRA is doing what it was intended to do when it was first developed.
An American Banker, last one.
When you talk about CRA, it can be years before some of the changes, whatever changes may be, manifest in CRA investing. Looking ahead, at what point do you start thinking about the other CRA, the Congressional Review Act, and thinking about how this regulation may shake out?
Well, let me just say this in response to that. I think it is important to understand that when a proposal is being made by a single agency for the most part, asking everybody else to sign on, there are so many things we don't know. The devil is in the details. When you talk about timeliness and the time that it's going to take for implementation, we don't know that. So that's why we've got to take this apart.
And I would add, if these regulatory changes are worthwhile, why can't they give us another 60 days to take a look at it?
It's an additional 60 days on top of the 60
That's
days.
right.
Exactly.
Absolutely.
Exactly.
Yeah.
If you're going to do this once every 2 decades, let's do it.
All right.
Thank you.
Thank you.
Thank you.
Thank you.
All right.